Have you ever stopped to think about where your money really goes when you invest in the S&P 500? You might assume it's spread evenly across 500 of America's biggest companies, but that's not quite right. Right now, about 40 cents of every dollar you put into an S&P 500 fund flows into just 10 companies, and a huge chunk of that, almost 8 cents of every dollar, goes straight into one name. Nvidia. It's a staggering concentration of capital, and it's all driven by one thing. The hype around artificial intelligence. This heavy focus on AI stocks is leading many to ask a critical question. Are we in an AI bubble? And if we are, is your money at risk? Let's break it down. First, let's talk about valuations. For the current stock prices of AI companies to make sense, they would need to generate absolutely massive revenues. We're talking about a combined revenue of somewhere between $5 to $7 trillion. To put that in perspective, in 2024, the total revenue of the top AI-related tech companies didn't even hit $2 trillion. The gap between current reality and future expectations is enormous. A perfect example is OpenAI. They've publicly stated they're willing to spend up to $1.4 trillion to achieve their goals. That's a mind-boggling number, especially when you consider their revenue is only around $20 billion. So where is all this money coming from? The answer is complex and a little concerning. A lot of this expansion is fueled by debt, but it is not the kind of straightforward debt you see on a company's balance sheet. We're talking about off-balance sheet financing through private credit, special purpose vehicles, and joint ventures. This makes it much harder for everyday investors to see the true level of risk these companies are taking on. What's even more fascinating is a phenomenon called circular financing. Picture this. Money flows from one tech giant to another in a loop. For instance, Nvidia might invest in OpenAI, then uses that money to buy cloud services from Oracle. Oracle, in turn, buys more chips from Nvidia to expand its data centers. This creates the illusion of explosive growth and revenue, but in reality, it's the same pot of money being passed around. It acts like a group of friends paying each other with the same $20 bill over and over again, with each transaction recorded as new income. This inflates revenues and justifies higher stock prices, without genuine new profits being created from outside customers. And what about the government? AI isn't just a business trend. It's considered a matter of national strategic importance for the United States. Many tech CEOs operate with the quiet confidence that if things go wrong, the government will step in to help. The bigger the AI industry gets, the more it becomes too big to fail, which means taxpayers could ultimately be on the hook. If a major crisis hits, this whole situation is amplified by the way most of us invest. The rise of passive investing through market cap-weighted index funds, like the S&P 500, creates a powerful feedback loop. When a company's stock price goes up, its weighting in the index increases. This forces the funds that track the index to buy more of that stock, which pushes its price even higher. Combine this passive investing tsunami with the circular financing we just talked about, and you have a recipe for valuations that can become completely detached from reality. Now, when the so-called smart money starts making moves, it's worth paying attention. Take Warren Buffett, one of the most respected investors of all time. He has been selling billions of dollars in stocks and is now sitting on the largest cash pile in Berkshire Hathaway's history. He's clearly signaling that he finds the current market unattractive. Then there's Michael Burry, the investor famous for predicting the 2008 housing crisis. He's reportedly betting heavily against semiconductor stocks, with a significant portion of his portfolio dedicated to shorting names like Nvidia. When investors known for their deep value analysis and risk aversion start heading for the exits, it's a major red flag. So, is this a bubble? It certainly has all the classic signs. The rapid rise in prices, the intense hype, and valuations that seem to defy fundamentals are all reminiscent of past bubbles, like the dotcom era. But here is the crucial thing to remember about the dotcom bubble. While many companies went bust in the short-term crash, the underlying technology of the internet went on to change the world. The same could be true for AI. We might see a painful correction, but the long-term impact of artificial intelligence is undeniable. So what's my personal strategy in all of this? I'm playing the long game. I'm not trying to time the market or make risky bets. I continue to reinvest my dividend income, and I'm holding a healthy amount of cash on the sidelines, ready for opportunities. I'm not using any margin or leverage. My investment horizon is 20 to 30 years, and I believe that over that time frame, staying invested in quality assets is the right move. Trying to predict short-term market swings is a fool's errand. Now, let's touch on Bitcoin. It's an interesting case right now. Typically, Bitcoin tends to move in tandem with high-growth tech stocks. But recently, it's been selling off. Even when the broader macro picture looks positive with the approval of corporations adding it to their balance sheets and gold hitting all-time highs. What could explain this? The macro explanation points to liquidity stress in the financial system. Because Bitcoin is so liquid and trades 24/7, it can act as a canary in the coal mine, signaling underlying problems before they show up in traditional markets. Investors who need cash quickly often sell their most liquid assets first, and for many, that's Bitcoin. From a technical analysis perspective, the picture is also cautious. The price has dipped below its 50-week moving average, a key indicator that some analysts believe signals the end of a bull cycle. While technicals aren't a crystal ball, it's another piece of data suggesting that caution is warranted. As for me, I'm holding the Bitcoin I have, but I'm not buying more at the moment. I'm waiting for a clearer signal. To sum it all up, the market feels frothy, especially in the AI sector. The combination of concentrated investments, circular financing, and passive investing feedback loops has created a potentially risky environment. The actions of savvy investors like Buffett and Burry suggest we should be cautious. A correction could be on the horizon. However, a short-term bubble doesn't invalidate the long-term technological revolution. My approach is to stay calm, stick to a long-term strategy, hold so may cash, and avoid getting swept up in the hype. It's about surviving the potential storm so you can benefit from the sunshine that follows. Thanks for watching. If you found this breakdown helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next video. Stay safe out there and invest wisely.